Good evening, everyone. My name is Liu Siyuan. Today, my topic is research on the co-movement of return rates in the Chinese and American stock markets. My presentation will divide into three parts. First, there is an introduction to the research topic. At present, with the continuous deepening of economic globalization and financial integration, economic and trade exchanges on a global scale have become more frequent, and the capital markets have continued to open to the outside world. The co-movement performance among the stock markets of various countries is becoming more and more obvious. This is a prominent manifestation of global financial integration. Compared with Western capitalist countries, China's stock market started later. American stock market and stock investment started earlier. After more than 200 years of development, the U.S. stock market is now very mature. We will compare the stock markets of the two countries from two aspects: the number of listed companies and the total stock trading volume. In terms of the number of listed companies, we can see that in the past 24 years, the number of listed companies in China has been growing, while in the United States has shown a downward trend. In 1995, the difference between the total number of listed companies in China and the United States reached 7164. In 2018, the difference is narrowed to 813. In terms of the total number of the listed companies, the United States is currently ahead of China, but the gap between the two countries is reducing. In terms of total stock trading volume, China's stock market maintained a relatively stable development before 2007, fluctuated greatly after 2007, especially around 2015. The total amount of U.S. fluctuated slightly in the history range from 1995 to 2000, and has been volatile from 2000 to 2017. China's overall volatility is greater than that of the United States. The total amount of stock trading volume has always been lower than that of the United States. This also reflects that China's current situation's market system is still not as stable as the United States. The stock market can quickly reflect the changes and development of a country's economy. As of 2019, the total number of listed companies worldwide has reached 32500, and the total number of listed companies in China and the United States have reached a quarter of the world total. The total global stock transaction reached $60.36 trillion, and China and the United States accounted for 70.3%. So this study will research on the stock markets of China and the United States. They are very representative. This research is devoted to studying the following two questions. First, is there any correlation between the stock market returns in China and the United States? Second, if it exists, does this co-moment show that China has greater influence on the United States, or does the United States have a greater influence on China? The research objective is to study the relationship between the Chinese and American stock markets based on stock market yield. Specifically, first, describe the co-moment between the stock market returns of China and the United States. Second, analyze the impact of the stock market yields of China and the United States on each other. The significance of this study lies in the fact that from the government's point of view, the United States and China are the most typical countries of developed and developing countries. Any action on the capital market level of the two countries will have a central impact on the global capital market. By studying the relationship between the stock markets of the two countries, we can have a deeper understanding of the relationship between the capital markets of the two countries, and provide experience for China to achieve financial liberalization, further enhance the stability of the stock market. From the perspective of investors, because the daily opening and closing times of the Chinese and the U.S. stock markets do not coincide. Studying the co-movement between the two countries will help investors make judgments and adjust their investments. They will provide greater possibility for diversifying investment, avoiding risks, and increasing returns. Next, we will analyze the literature reviews. The theoretical literature is mainly divided into the economic foundation hypothesis and the market contagion hypothesis. The economic foundation hypothesis is from the perspective of the real economy of various countries. Through the interdependence and interconnection of the real economy between countries, thereby driving the motor co-movement of the stock market between countries, like Connery 1998, Anderson 2007, and Goon 2015. In contrast, the market contagion hypothesis believes that investors are irrational due to the instance of investors. Irrational behavior will quickly separate from the stock market to other stock markets, causing other stock markets to fluctuate in the same direction, thus showing that the two stock markets have a co-movement. The empirical literature is mainly divided into a VAR model and GARCH model. The VAR model describes the evolution of stock market price over time. The GARCH model is an extension of the ARCH model. When using it to analyze the stock market co-movement, a related promotion model is made based on the GARCH model. The research on the co-movement of the stock market mostly exists between developed countries, or between developed countries and energy Asian countries, concentrated on the subprime crisis, financial crisis, and other events before and after. There is a central loss and incompleteness in sample selection and data time. Therefore, this study will try to fill the gaps in the literature from three aspects: regional limitation, data limitation, and time limitations. The third chapter is research methods. This study will use the GARCH model to analyze the daily return rates of the Shanghai Composite Index and the SP500 Index. The dependent variable is conditional heteroscedasticity of stock market returns, generated by eViews based on the data return rates of the Shanghai Stock Exchange Index and the SP500 Index. The independent variables are daily rate of return minus return error term square, and condition variables of the square of daily rate of return minus return error term. eViews are generated based on the daily rate of return. In terms of empirical methods, first we will use the ADF test. ADF tests data stability. Then through the Granger correlated test, it is concluded that the data return rate of the SP500 index is not the Granger cause of the change in the daily return rate of the Shanghai Composite Index. Before modeling the GARCH model, an ARCH model test is also needed to determine whether there is a volatility clustering effect in the time series data. Finally, the GARCH 1.1 model will be constructed. This study used the daily return rates of the Shanghai Composite Index and the SP500 Index from January 2, 2009 to December 31, 2019 as time series data. The Shanghai Stock Exchange Index data used in the study comes from the official website of the Shanghai Stock Exchange, and the SP500 Index data comes from the WIND database. That's all. Thank you.